One stock just cracked today's top 5 for July 15th, CRWD. CrowdStrike just rallied 12.14% and is flashing near all-time highs, but here's the thing. Most retail traders completely missed this move. While the stock climbed, an ETF holding it captured a 29% return over 6 months, which tells you professional money has been quietly rotating in. The question isn't whether CRWD went up. The question is whether there's any fuel left in the tank, or if we're watching a fade into air. This is a watch verdict with moderate conviction, not a screaming buy, which means you need to understand the technical setup before you decide. If this is a valid pullback entry or a topping signal disguised as strength, price is at $210.73, just 0.1% below its 52-week high, which means any pullback here is literally fighting gravity against its own recent ceiling. Support sits at $165.23, which is 21% below the current level. Resistance is at $210.95, basically your price right now. The real tell. Volume is running at 0.95 times average, slightly light for a rally this strong, which is your first red flag. When a stock rallies hard on whisper-thin volume, the upside move is fragile. The good news, the 50-day moving average is at $166.7 and the 200-day at $128.3, both well below price, so the uptrend structure is intact. But structure alone doesn't pay for an entry. RSI is at 69.47. That is neutral territory, not overbought as many assume, meaning there is still technically room for the stock to run if sellers stay out. The difference matters. RSI above 70 triggers automatic reversal hunts by quant programs, but 69 sits in a gray zone where momentum can extend into resistance. The moving average alignment is textbook bullish, price well above the 50-day, the 50-day well above the 200-day, no downside crossover in sight. However, your original entry zone was $182.7 to $188.18, which is now 10% below current price. You missed that window. This changes the risk math. You are not buying at a discount. You are buying at the near peak. Here's what we don't know yet. Earnings date is not listed, so you are flying blind on the next catalyst event. The key thesis is also marked as data unavailable, which means the analyst work on why the stock should keep rallying. Product momentum, market share gains, pricing power, hasn't been written down. In a cybersecurity market crowded with Palo Alto, Microsoft, and Okta all fighting for the same IT budgets, the risk isn't the sector, it's saturation and new competition. A single negative earnings miss, a guidance cut, or a customer churn announcement would shatter this setup and send sellers into the gap below support at $165.23. Moderate conviction means the downside risk is not trivial. Put-to-call ratio is at 0.628. That means for every put bet on CRWD falling, there are roughly 1.6 calls betting it rises, which is bullish options positioning and suggests smart money is still rotating upward, not hedging exits. This is your strongest bull signal. Implied volatility at 0.6321. Context would help here. Is this the 30th percentile of its history, or the 80th? But assuming it's not at multi-year lows, options are reasonably priced for both sides. You are not overpaying for call protection, but you are also not getting a screaming deal. The options market is saying, yeah, more upside is plausible, but not the stock is guaranteed to explode. That matches the moderate conviction verdict perfectly. Your verdict is watch up with moderate conviction. Translation: this is not a screaming buy, and it is not a short setup. It is a stock worth observing for the next move. If you missed the $182-188 entry zone, here's what to do. Wait for a pullback into that zone 21% below current price to rebuild your risk/reward, or skip it entirely and move capital to other setups where the entry still exists. If you do enter here, your stop loss is at $166.61, a 2.4% cushion before the trade breaks, and your targets are $210.95 first target, already in sight, $226.05 second target, 7.2% above, and $273.43 third target, 29.7% above. The R/R ratio is 0.0, which is a red flag. Your risk relative to reward is unfavorable here, suggesting the setup is better for a trailing stop position than a defined risk entry. CrowdStrike watch up is not a confirmation that you should own it right now. It is a signal that the stock has directional bias higher if it holds support and if the options market stays bullish. The missed rally was real. A 29% ETF move is no joke. but the time to chase it aggressively has probably passed. Your best move, if you own it. Hold it and trail your stop, if you don't own it. Wait for the pullback into $182-188 or skip this entirely and hunt for the next asymmetric setup that still has 30% plus upside with a 5% stop. Moderate conviction means the stock is not broken and is not a screaming opportunity. It is a trade at fair value with moderate upside risk. Watch the next earnings date closely. That is when conviction either rises to strong or falls to weak.